In every scenario, what are we selling here?
Insurance.
Okay, so we're selling a life insurance product. Agreed?
Yep.
So debt-free life, infinite banking, whatever the hell anyone wants to call it. What we're actually doing is selling an insurance product that comes with beneficial use. So let's talk about the beneficial use. How does it work? This product allows you to buy more life insurance than you actually really need. In fact, you decide how much life insurance you're going to buy by creating the participation rate, what we call your contribution. And that can vary by person, right? 500 a month, 5,000 a month, whatever. Okay, it just depends on what you want to park. Notice I didn't use the word spend, because the way it works is I'm going to park it at the insurance carrier. While it's there for this product, it's going to overbuy life insurance on the amount that I wanted, right? So if I park 1,000 and the regular life insurance for me at 30 years old should have been 100 a month, 900 of that 1,000 is going to buy extra life insurance. Okay. Now that extra life insurance is expressed as an asset, like a gold bar or a piece of jewelry or a home. It's an asset that currently has no lien against it, nothing. It's free and clear asset. Okay. So if he puts 1,000 and 900 of it becomes the asset, what can be done with that asset that's going to be expressed with a value? What is known in the industry as cash value. Cash value is the value of the extra life insurance he purchased as the asset. Well, because he has an asset at the insurance company of that amount, let's just say $900, right? 100 went to his regular life insurance and 900 was extra life insurance that was purchased, creating that asset. The insurance carrier is willing to lend him money against that asset, what's called a collateralized or secured loan, right? They're holding the $900 of asset. And so he can go to them and we cap him at 90% because we want 10% in case of emergency. So he can borrow 90% against that $900 asset, which comes out to $810. Now, when he borrows the $810, it does not change the value of the asset because it was a collateralized or secured loan. You with me so far? Okay, why is this valuable in this product? That process I just described is the most valuable thing about this product because while they're still holding the $900 asset, it's growing with interest. The whole amount. So the whole amount is growing with interest. And when we use a specific carrier like Foresters, for the last 20 years, it's grown at about 6%. So $900 is sitting at Foresters, that's a collateralized asset, growing at about 6% annually. Meanwhile, I've got $810 in my hand over here out in the world that I can use. Now, you tell me, where else in America, what financial vehicle allows me to grow the full amount of my money and use it at the same time? So that's the secret sauce to participating whole life. Now, behind that is that when the right agent creates the right amount of insurance, this whole process is tax-free. It's devoid of any taxes. So ultimately, why is it championed or marketed towards debt? Because as I'm growing my $900 asset and I've borrowed $810, I've created a new debt, right? There's a loan against my asset. And if I don't pay it back, they're going to deduct it. So I do have debt. So in fact, I tilted the debt. I didn't get debt free. I tilted the debt to a place that's earning me money than costing me money. But now I take that $810 and let's say I have a credit card that has $800 on it. I'm going to wipe out that credit card. And so now that credit card has got no loans on it, which means whatever interest they were charging has also gotten wiped out. Then I'm going to take the $50 a month I was sending to that credit card. And where am I going to send it? Back into the life insurance policy on top of my $1,000 a month. So now, because I'm parking $1,050 a month, I'm repaying the loan. I'm also cycling more money through it, and I'm compounding the interest internally. I'm creating more money towards myself. This is the debt-free life program, right? That takes scheduled interest away from the bank by allowing me to borrow against my own money, pay off the bank, and then take the debt service and pay myself back, and re-collateralizing for the next loan. It's what we call out in the industry the snowball, right? So I'm going to borrow, pay the lowest, re-collateralized, borrow again, pay the next one, re-collateralize, and we end up paying off all our debts in way less time, cycling the money differently. That's the beauty of the debt-free life program. When you talk about middle America and people have debt, right, there's limitless application here for people. Now, when we get to someone like your person who has no debt, we go, oh, the debt-free life program doesn't work for him. Untrue. The debt-free life program was just a concept using participating whole life. What do other people use participating whole life for? Well, essentially, when I have a collateralized asset that's secured and it lends out money and it is growing in interest, it's the same as a bank. That's what a bank does. A bank has secured money, lends it out to you, grows with interest. So one other thing we call this is infinite banking. Why is it infinite? Because remember, because it's secured and collateralized, the whole amount is getting the whole amount for good. Not every insurance carrier does it that way. So getting with the right person to be able to do it is important. So if the whole amount is growing at the whole time, just growing, and I can take it out and use it and put it back, what are some other applications that someone like your person who has no debt can take advantage of? Let's talk minimally, right? What can you do with participating whole life? In a participating whole life scenario, in around 30 days or less after the money's been parked, it can be borrowed against. And then I can go use it for whatever I want. Some people take that money and they invest it in real estate, in crypto, in stocks and bonds. Now, you're saying to me, well, Keith, I just created a new loan and I'm taking money and putting it out there. Sure. But we just created what's called positive arbitrage, which means I'm cycling the same money through more than one vehicle to create interest. So if I cycle it into the life insurance policy, which is creating that dividend and interest, say 6%, right? And then I borrow it out and I go put it in crypto, which triples, I made money on my money. If I just took the money and put it in crypto and it tripled, great. But over here, I've got secured, guaranteed slow growth too. This is what the wealthy do. They don't spend it out in the world. They cycle it through, then spend it out. And they just keep that cycle going, right? So what is one key that people argue against in doing this process? I don't need life insurance. Well, when you do the math, say 5 years, 10 years, depending on the age of the client and their health and so on, most times around 10 years or less. Because of the slow growth and the guaranteed process, right around the 10-year mark, we've typically put in the same amount and receiving the same amount, right? So let's just say I'm taking tax-free loans, saving on capital gains, interest, all kinds of neat stuff. If I own a business, I'm going to be able to take some tax deductions for the participating premium, all that, right? We're not going into all that. Let's just say over 10 years, this client puts in $120,000, $12,000 a year. And his cash value at 10 years is $120,000, whether he's recollateralized or not. Couldn't one argue that he's gotten his money back, that he's even? And if that's the case, whatever death benefit is sitting out there on top of that is almost like no-cost life insurance, right? We don't say free life insurance, and he definitely paid for it, but he created enough dividend and interest to find himself in an even place. And it's a permanent death benefit. It's never going away. So either now he's created some life insurance that he can leave behind for sure, or he can go sell it to a life settlement company and make even more money, which is typically taxed, but that's, again, a whole nother discussion. Now, when someone like your client is 30, usually at about the 10-year mark, he would have put in 120 and he's going to have like 160 or 180 of cash value. So not only has it grown, he's grown his money, plus he's got this death benefit. And again, when done with the right person, we could like stop his participation, his contributions, and he'll draw guaranteed cash value for the rest of his life, growth every year without giving them anything. It is the most unbelievable, spectacular, fantastic concept that is proven by guaranteed math that I have ever run into in my entire life. And sadly enough, the only thing that keeps people from moving forward is they don't think they can qualify or afford it, which is untrue, right? It has much more wide open qualifications than most of the non-medical things because there is a process, or they're just afraid that it doesn't work and they're not really listening to this explanation. Now, as a last piece, some folks would argue an IUL, Index Universal Life, is better for this client who's 30. Every client's needs are individual. They're unique. Because let's just say he has no desire to start a business, invest in real estate. He just wants tax-free retirement. He could just keep stocking $1,000, never borrow, and at 65, he's gonna have millions, right? You could still borrow on an Index Universal Life as well. It just takes a little longer than, say, a participating whole life, depending on the product, because early on they're wanting to recoup their money. And finally, the Index Universal Life is tied to growth of the market. So it doesn't come with a minimum guarantee typically. It outperforms the participating whole life when the market is great, right? 8, 9, 10, 12%, 16%, whatever. So that's exciting. But essentially, it just comes down to the person, right? If I'm working with someone who's 50 and wants to retire in 15 years, they're better off with guaranteed growth than someone who's, say, 30, has a long time to recoup, like when the market drops 20% in 2022, right? So that means he didn't lose any money, but he didn't grow. Whereas the person who had guaranteed growth and an average perspective of 6% definitely grew. That's why each individual person is a different case. It's a different scenario, and it is so super important to spend time with them, asking them the right question. You got to have the right person. And that's why I, suggest to you, right? You put someone like me in front of them and we ask the right questions. So we build the right plan. Essentially, it's a insurance financial plan. Right? We got people with certifications who call themselves financial planners, and they do amazing stuff and amazing work, but they deal in a whole different subsector of the financial market than, say, someone who is working in this area of insurance. Why do we get insurance? Because it's guaranteed. That's why. Does that kind of put it in perspective for you?
Yep.
Cool.